Alrighty, good evening, everyone. Welcome to the Hurley Investments Market View Commentary for Monday, August 5th, 2019. Plain and simple, to make it as simple as I can, S&P 500 lost 2.9% today, and 3.12% on Friday. Total, that comes out to 6.02. So in 2 days, we have a 6.02% loss. So out of curiosity, who's panicking? Is there anyone here that is panicking? Okay, I see a couple no's, but someone typed in, I'm worried. So that is a good way to look at it. Plain and simple, if I was going to say it, I would probably say it exactly the same way. Kevin, no, I'm not panicking, but I'm worried. I've got a I'm gonna write it in because I have to. Just like the man who swallowed a button, this too shall pass. I love it. So no one's panicking, right? No panic, but worried. And that makes sense. I mean, in all honesty, that's made a huge bit of sense. So why aren't you panicked? Why aren't you panicked? Because in all honesty, you know, no panic but worried, but why aren't you panicked? That's going to be my question. Because you've got some puts in place for me. So I'm going to say it this way, because long puts are still in place from earnings. And remember, long puts are your protection, not short calls. Short calls might give you 1.5% over a 2-month period of time, which means you have 98.5% still at risk. But yes, because you have long puts because of earnings. I like that one. What's another idea? Because we're beating the market. Which makes sense. In all honesty, I kept it open for you guys. Market was down 2.98 today. 2.98. And and 122, 188 divided by 77. I'm down 1.57% today. The other day I was down 1.76 on the 3.12. So yes, you're beating the market, but my question is going to be, and I'm going to ask this in a second, how are you beating the market? But before I hit that, let's keep going. Why are you not panicked? I'm going to throw mine in there because we've seen this before in May. Can I go a step farther? Because we already knew that China was a currency manipulator, or they are trying to hold on by the skin of their teeth. Now, I'll be honest with you, I'm going to buy into both. I'm going to buy into the, yes, they are a currency manipulator. They always have been. But I think as of recent, they've been trying to prop up their currency. And in doing so, by propping up their currency, they have also, for lack of a better term, in propping up their currency, they have been doing so to do nothing more than trying to keep their dollars. Well, Kevin, China has a ton of dollars. And I might go as far as to say as they did have a ton of dollars. But to loan it out to their banks, and then their banks loan them out to do other stuff would be the easiest way to say it. I'm not sure they have tons of dollars, to be honest with you. First time it's dropped below 7 to the dollar. If I can add one more thing into all this, the world economies are slowing down, i.e., Europe. I'm sure there's some, you know, I'd even say down south with the lower oil prices, but the world economies are slowing down. So the short answer is, can it get worse? Yes. But how are you beating the market? That's what I want to focus on. Kramer tells people to hold on, find some money, and start to nibble on fundamentally sound companies. So if you have had money in the market, go ahead and don't panic. Watch it go down 6% over the last 2 days. It's what you're supposed to do. And go find some more money so you can start to nibble on it. Because you're supposed to be, in all honesty, you're supposed to be basically fully valued. Because it's been a bullish market, right? You should be fully valued. Now the question is, why not have puts and sometimes calls to make up some of the downward movement? Protective put strategy. Now, I'm not comfortable with full callers for the most part. About the only thing that I would fully collar right now would probably be Baidu. So much stuff has the opportunity to bounce up. AP just typed a bunch of stuff and he's exactly correct. Not slowing down, is changing in very fast ways in many areas, affecting jobs, purchase power, also the on-demand type. I would kind of agree with that, but not really, because GDPs are falling. So when GDPs are falling, I'm going to tell you that world economies are slowing down. And that's something you got to be careful of. You just need to be careful of world GDP slowing down. All right, let's see what else I'm trying to go here though. Oh, going back to the protective puts. So I'm going to pull up a chart. And this chart's on Under Armour. Most everyone on Under Armour has had protective puts at $27.50. Had them right before their earnings. So pretty cool to get your puts put on, most likely right in this area, right? Protective put. So there are some people, when they saw this bounce up after a big drop and a pivot point, took off protective puts, made about $2. What is the problem with that? What is the problem with taking off protective puts right there? Got a good group here. We now got 17 in. Pivot point is your only technical indicator. Okay, so yeah, there's a pivot point at 24.28. But what justifies taking puts off right here? It doesn't. It's a mistake. I'm going to agree with that. A pivot point is not necessarily a technical indicator, though it has been used in the past. A pivot point is not a technical indicator that will justify unprotecting stock ownership. Now, I know some of you are going to contradict what I'm going to say. Yes, you could have told me, Kevin, I saw the bounce off the 200 day, so I took a shot. If you had said that, I would have agreed with you. But usually I'm going to give 1 or 2 days for it to prove itself. So yes, at 1 standard deviation today, did I take off protection at 12.76 and convert $6.62 or $4 and change to shares? I certainly did. Am I taking a bit of a risk? Of course, especially when we're looking at some pretty bad what am I trying to say? Some pretty bad futures. Our futures already look down 200, 300 points. I'm going to contradict that, though. I'm going to tell you, because our futures look bad right now, I think we're there. I think we're there where we're going to be okay. So one of the points that I'm going to try to suggest, don't exit the long puts forgetting about what that is protecting, i.e. long stock. It's not important to have 100% return on a protective put strategy. That doesn't help you. What's important is that you are protecting your stock ownership. I will be honest with you. On one stock today on Under Armour, I'm going ahead and I'm taking a shot at it. But I will have protective puts ready at 20. Because if it breaks 20, 17.50 is the next stop on the way down. but I'm taking a shot. Why am I taking a shot? Well, if I take $8, $8 divided by 28, it's fallen 28.57%. We're getting close to that 33, 34% Fibonacci. I'll be honest with you. If I was to take a look at Under Armour, way oversold. Way oversold. And my bounce up is really only going to be from here up to 2030 or 2230, excuse me. That's where I would start looking to put protection on again to go back and retest the lows. I'm not sure we're going to see a V-shaped recovery. But that's what I would be looking at. So I took a flyer on one stock in portfolios. Pretty interesting. My flyer I took out on this is Under Armour. This is not Facebook. This is Under Armour. So pretty amazing today because if we just take a general look, boy, bought a huge quantity and I sold to close a huge quantity of those 27 puts. And I got to do it at a darn good price. 665 up to 674. Averaged out to like 669. And then I dumped in a bunch of shares. How many shares? 300, 600, 7, 8, 9, 10, 15, 20, 25, 31, 3,400 shares. 100% paid for by the protective put strategy. That's where I'm going to come down to. It depends how you're protecting. It depends how you're going to beat the market. It's going to depend on your timeline, and it's going to depend on the fact that you get a couple things right. If I am wrong and I'm not getting it right, then I'm obviously going to have to get long puts back in place. And I've got about 76 cents that I can play with. 76 cents on a $20 stock is about 0.76%. No, it's not. It's about 0.33%. 35, 0.38%. So I'm going to give it a 0.5% wiggle room before I'm putting on my long puts again. 0.5% wiggle room is what I'm going to give Under Armour as I take a shot. A lot of people might ask me, Kevin, why would you do this? Well, we just entered a bearish oversold, and I like that we got a bounce off of the 200. Some money came back into our market today. If I brought up the S&P 500, I'm looking at kind of the same chart. There is not a bounce off of the 200, but we are getting a buy into the close. And then much the same with the NASDAQ. If you ask me where August will end, I think we'll be flat. I'm very close to changing my mind there, but our earnings did pretty well that I think we can be flat. Again, what's making my decision part of this comes down to an interesting article. Save, invest, speculate, trade, or gamble. It's a pretty interesting article, but here's what I'm going to tell you. This gentleman's been looking for bargains all over the world in every type of market. Of course, that's what a good investor does. The reason for this abnormality, where there's nothing on the other end of a seesaw, is the worldwide QE, quantitative easing. It's pushed us through some of what we've been going through. He looks for distortions. He thinks it's okay to buy when blood is running in the streets. I know a couple people, I know 3 people that thought Friday was the day to get back into mutual funds, to get back into ETFs. Oops. That's been pretty painful the last 2 days. The last 2 days you'd had over basically a 6% drop. Saving means you set some money aside, you're going to get 1%. If you have over $25,000, you could get 2.57% in a wealth fund. Investing has some growth. Speculating. In point in fact, I wish we lived in a world where speculation was redundant and unnecessary, but that'd be a world where the state had no involvement in the economy. A trader, a gambler. I found the article interesting. He felt that the speculator has the best chance of coming to head in the long term. I would disagree. I think a trader that has a method that's not psychologically draining or attention intensive has the ability to beat the market through adding shares. It's not just lowering the cost basis. Your explosive growth and opportunity back to the upside is not only from beating the market with a protective put, but it's then juicing or an exponential return on the way back up by adding or converting those profits from the puts and the calls into more shares of stock. People always ask me, Kevin, why do you do more shares of stock than spread trading? And I will be 100% honest with you. The number one reason is because when I go to shares of stock, it has a 1 delta. With a 1 delta, I give myself the ability to make great money. Maybe for the next 1 delta on Under Armour, I'm going to give myself the ability to make money at an exponential or 20 to 30% more shares in the portfolio. That's why I protective put or collar trade. That is why I do what I do. And that's why I believe in the protective put or collar trade system. If I go to earnings, we don't have earnings that'll move the market this week. Nothing that gives me an idea that says, hey, I'm good to go. There's no big economic reports. It's going to be news driven. It's going to be China driven. It's going to be China driven to the point of, hey, what's happening? What's going to move our markets? When are we going to be to a big enough oversold position that we're going to be okay? That we're going to be, hey, It's okay to take a chance. It's okay to throw some opportunity or some money into it. And that's going to be the part that I think will most likely come at the end of the week. We might have one more washout day tomorrow. Wednesday, I guess the short answer is because for the majority of things, except for Under Armour that are already protected, I might even stay away from the market till the last hour tomorrow. I might just say, you know what, I'm going to go ahead. I'm going to not overreact and keep making up more on the downside on long puts that have a really good 0.6, 0.75 delta into the downward movement. There's nothing really that's going on internationally till Thursday with China economic reports and trade balance in their CPI, their inflation reports. So I feel like I've got some time. A couple people still think there's not enough blood in the streets. Patience is gold, and I will agree. But Wednesday, I think, will be the day with another big sell-off tomorrow. So you're going to prepare for it. Can I do a short term, try to sell a call? Possibly. But I'd have to pick a support level or two above and see if the risk is high enough, if there's enough credit to justify not participating in a bounce back. Earnings coming up tomorrow, Disney. You want an interesting trade? Disney should have its highest ever revenue for the company for a quarter. What an amazing opportunity you have on Disney. Huge opportunity. All right, let's see what else. What else do I have for you before I'm going to take some questions? It's not just the Fed and Trump, the trouble with the stock market. It has some information here in regards to earnings, low expectations, lower guidance. I also have an interesting article on the logic behind the bonds that eat your money. Definitely, this is one. Click on the link. I disagree with the, well, he explains the logic ahead of time or what it is, but I do think it's rather ridiculous. I can't believe that people are holding it in a negative yield. And the reason why is because they're most likely required by their charter. You're required by your charter. Doesn't make sense for 10 years to give them $100 and receive $95 back. But that's where we are at. Definitely click on the link and head to read why some people are in a yield bond, a low yield bond, or a negative yield, and why people have put their money into that. With that said, what questions do you guys have? Let me see if I can't spend 10 or 15 minutes answering your questions. If not, there's not a whole lot to tell you other than where are we looking for the bottom? And I think we bounced off it on the Dow. Because of buying at the close, I think we could be testing a couple hundred points lower on the Dow, 20 points lower on the S&P. Any questions you guys have? Kevin, is there any trade you would do tomorrow? Again, I would do a protective put on Disney, but I'm going to go with APD. Still not blood in the street. Patience is golden. I don't think you need to force a trade right now. And earnings, you have MRO on Thursday. You have Disney tomorrow. I think you've got some time. I don't think you need to push anything at this particular point in time. So no, I think you can sit back and be a little bit, if you already have your protection, you're good to go. How do you see financial equities? I think they're way oversold. I think they're way undervalued. I would expect financials to make that big run up sometime from a low in August up to some pretty significant highs into the end of the year. I'm also basing that on the home sales that we've had. I think they also will try to close a bunch of, for all intents and purposes, I think they'll try to close a bunch of loans at the higher interest rates that they're going to be before a September rate cut again. So I think you'll see that push and that run. Again, I would be a fan of financials right now because they are undervalued, and I also think that they are, for the most part, oversold. Any other questions? Good question, by the way. Can I define futures for you? Yes. Futures are the buying or selling that occurs after the market is typically open or closed. So I can say that. Yes. So for example, futures open up about a half hour, the market closes for 2 hours, and then you'll see overnight futures on the major indexes, preferably the S&P. After that, which you will see futures open up an hour and a half before the market opens in the morning. So the futures are the buying or selling that occurs pre-market or post-market. And it's usually done on typically very light volume. And it's done by some major hedge funds or institutions that that have the opportunity to really do that ahead of time. So those would be futures, if that answers your question there. All right, hey guys, have a good evening. Lee, apologize for last week. We were trying to do the best we could to say, hey, not much to discuss or go over by way of trades, and we just do the best we can to be helpful. So please take a look at some of the emails so that we don't catch you by surprise. All righty, guys. Hey, have a wonderful evening. Lee, I think they could be helpful for you at all times. If you have the time, feel free to jump into them. If you miss my live ones, you can pick them up usually a day later at myhurleyinvestment.com. So if you go to myhurleyinvestment, you'll be able to pick up the trade findings and announcements and or the market commentary. Guys, take care. Have a wonderful evening. And I will look forward to seeing you tomorrow night, 6 p.m. Mountain Standard Time. Have a good one. Bye-bye.